Hello, everyone. We made it to Friday, May 22nd, 2026. This is the market headline report. It is another beautiful afternoon here in the Midwest. In this week's episode of Fantasyland, the stock market is going to close at another record high as AI junkies binge on magical thinking and debt, perfectly demonstrating their ability to completely avoid reality despite the overwhelming evidence that things are not getting better. Let's check in with the news. The headline is Pinocchio proclaims peace again. Stock market hits all-time high. Chutometer is at 99%, pure fiction. Money printing never stops. They just printed another $2 trillion over the last year to fund various ventures like quantum computing and plugging up the debt market so that it doesn't completely implode with all the treasuries that foreign entities are selling. Japan is a big one, sold billions and billions worth of treasuries recently. Also, China is dumping U.S. debt. So the market needs to come up with the cash to cover that selling pressure somewhere. And I guess the Federal Reserve is just going to print it in the similar fashion that it has been doing for almost 2 decades now, since the 2008 crisis. Crude crashes again. It's down again today, trading at about 96.50. We had record inventory draws. We have war escalation. And sure enough, due to the fundamental laws of supply and demand, when the supply is threatened, we go down in price. That makes a whole lot of sense, right? AI hype sends stocks to the moon with infinite funding and infinite insanity. Quantum computing efforts in the big tech space are being funded by the government. They just printed a couple $1 billion to give to IBM and a few other companies for quantum development research. So that propelled the Dow Jones to an all-time high. The Nasdaq is sitting at an all-time high, and of course the S&P is, almost at an all-time high, about 75.50 is what it hit a few days ago. We're going to be going for that here pretty soon. Also in the headlines, war. What war? Nothing to see here. Move along. Peace deals signed daily by people no one elected. Wow, I'm going to have to check the validity of that. This article says by people no one elected. I'm not sure if that's true or not. I'll have to verify that story. Stock buybacks at record levels, of course, that makes perfect sense. Retail investors bag holding hard. When the market turns south, that's if it ever does turn south, the retail investors will be the last to know, and their trading platforms will probably experience, glitches and interruptions in service, which will not allow them to get out of the market even if they want to anyway. The Fed has your back. Print, pump, pretend, repeat, extend and pretend. That is the magical thinking that is firmly in place in the market today. We're going to extend and pretend and kick the can down the road as far as possible. However, this time around, we're going to have some difficulty with that because we can't print more oil. Washington fact check study false as usual. New day, new lies, same game. The public forgets, the markets don't care. US debt now over 40 trillion. I put up the debt clock yesterday. It's 39 trillion. It's going to hit over 40 trillion pretty soon. So this is not too far off the mark. This headline's going to be true pretty soon, probably within the next month or two. Let me fix my view here so you can see me again. We're going to look at the collection of headlines. This is the one from yesterday. Iran says no deal will materialize if U.S. insists on enriched uranium handover. So supposedly there's a peace deal, but it hinges on the enriched uranium handover. They're not going to do it, so therefore there is no peace deal. Memorial Day melt up. It's a holiday on Monday, so that's a good excuse to buy more stocks. India's power demand hits record high as heat drives coal use. They're substituting coal now instead of oil because they can't get the oil in Far Eastern countries. Here we can still, produce some of our own oil and we still have gasoline. There is rationing and much more extreme circumstances in effect across the pond over there. Goldman's Pasquariello answers Money Manager's top 5 questions. Okay, wonderful. How much more can I buy? How many more tech stocks can I leverage my account for? Max it out. Give me the most available, meme stocks for my margin debt here. There's an Ebola scare. There's a hantavirus scare. So we have some virus scares going on. Won't get into that. That has nothing to do with the market, but that has, obviously everything to do with, the well-being of humanity in general. It's a completely different subject. Rising interest rates, why the narrative fails against the data. This is important because yields have been going up. The interest rates have been rising implicitly through the action in the debt market, as I, pointed out before, with foreign entities dumping record amounts of U.S. debt. This is by Lance Roberts. He's pretty good. You can find him on YouTube giving interviews with Adam Taggart. Last Friday closed with the 10-year Treasury yield at 4.6, a one-year high, and the doom commentary about rising interest rates was waiting before even the bell rang. Hyperinflation, bond market breakdown, paradigm shift. A 1981 fair value retest. The Fed is about to push the Burr button or pop the everything bubble. So they have to print in order to hold the debt market together. This is the same story that revealed itself in 2007, 2008. They have to print more money to hold the debt market together because of the pressure that has been building in there. If you spend any time on social media over the weekend that followed, you saw a version of every one of those. So I posted a short thread that Friday making a simple point. Over time, yields track growth and inflation. The chart that drew the strongest pushback roughly showed that the relationship and a wave of responses argued that the framework is broken. Debt is about to break the bond market. Supply side inflation has changed everything and rates have nowhere to go but higher. The inflation is everywhere. We do have the worst energy crisis that is contributing a lot to the inflation right now, but we had a massive inflation problem before the energy crisis started and before all this really showed up in the data. It was starting to show up in the data years ago, but they were able to massage the values of the inflation reports in order to give the impression that it wasn't that bad, right? Inflation is transitory. It's going to pass. It's not a big deal. Well, we've heard that story before as well. Meanwhile, grocery prices are significantly higher than they were a year ago and grotesquely higher than they were a few years ago. And now the energy prices are starting to hit because of the war and the energy supply shortage that the Strait of Hormuz blockade is causing. If we look at reality here, something that nobody wants to acknowledge lately, the Hormuz deficit clock reality. The strait has been closed for 83 days, 19 hours, 16 minutes, and 13 seconds. Total barrels of crude oil lost since closure, 1.156 billion. We're losing about 14 million a day. 104 million global daily demand. There's no demand destruction yet. The market still thinks that everything is going to go back to normal. It is not pricing in a crunch or a deficit. It is pricing in, it's not pricing in an actual shortage. It's pricing in a deficit and a crunch right now. This is going to be a shortage in the future. It's going to take 3 to 6 months to work its way through the system and manifest itself, but this is really serious. 2.57 times the crisis of the 1973 Arab oil embargo, where we lost 450 million barrels. We're going to lose another 97 at the end of the week. The main metric that I'm watching right now is the Cushing Hub, which is a measure of the inventory in the Oklahoma storage facility. It's at 22.12 million barrels. The operational capacity is 20 million barrels, so it's 3.8% above its operational minimum. If it drops below the minimum, they have to shut the facility down because there's no longer enough pressure in the pipes to draw up the crude. This is a huge problem. Last I checked, gasoline prices here in the Midwest were $5.29 a gallon. Diesel was around $6.65. I'm going to update these after the weekend. The gasoline futures definitely took a hit this week. Let's check in on the price action of the crude oil and the gasoline this week with all the war and, inventory draws and then the peace negotiation deals. It seems that the war escalation and the inventory draws, record inventory draws, we're drawing the most out of these storage facilities than we've ever drawn before. And the market is under pressure. The crude oil went from 104 a few days ago. Now it's down to 96 and a half. The gasoline is at 334.77. It did roll, so the next month out was a little bit of a discount to the front month. I don't know how that's possible considering how the Strait of Hormuz is closed and does not look like it's going to reopen anytime soon. How does the next month forward in the energy market price a discount in this environment? It makes absolutely no sense. And that also doubly makes no sense because if the interest rates, if the yields are going up, then the cost to carry is more. And if the cost to carry is more, then these futures contracts should be trading at a premium, not a discount. So this whole equation just absolutely makes no sense. And this is why I call this week's episode Fantasyland, because nothing seems to be real at all. The gold market is going nowhere. 4550 to 4500 has been the range for the last couple of days. It's not going down, but it's not going up. Here's the S&P and NASDAQ. NASDAQ 29,600. We're almost at 30,000. Another couple of rounds with the printing press and some more peace headlines. We should definitely get the NASDAQ above 30,000 next week. And then everybody will put on their 30,000 NASDAQ hat and ride off into the sunset, right? Well, they're going to have to use a horse because there's going to be no gasoline in the car. S&P 7,500, like I said, 7,550, 7,540 was the high a few days ago. We're almost at that high, not yet. As long as the war doesn't completely engulf the entire world over the weekend, we should probably be able to get another new high on the S&P as well. If we look at the overnight action in crude, we started off at 98. We did the same thing. We rally up overnight with a steady bid. Then we sell off around the cash open. We hit the low, then we hit another low late in the session. It seems like the last couple of days has been up and then one hammer down around the open, a little bit of recovery, and another hammer down before the close. And now we're recovering from the second hammer down. This is almost identical to the pattern yesterday. Gasoline is a similar picture. We chopped around, we went up, we went down, we went up, we went down, and we're going to close, pretty steady. We look at the overnight action in NASDAQ. NASDAQ has been pretty positive, 29,500. We're up a couple hundred points. We have not really threatened the low here at 29,450. We've got 30 minutes left to go in the day. We're probably not going to make a new low. We're probably going to close pretty steady. This is above the previous day's high here at 29,550. So that is the technical picture of the market. Let's go back to this one headline here. More reality. Nobody wants to acknowledge reality, but UBS now has a study that really is quite alarming, and it actually matches a little bit more of what I'm saying. So I'm getting a little bit of satisfaction out of reading this article because now other people that are well informed, much more well informed than I am, and have access to things that I can only dream of at institutional firms, are making this conclusion. Now, drawing down crude inventories at a record pace with SPR releases doing the heavy lifting to cushion the Gulf supply shock only delays the move higher in crude oil prices. Once those buffers are depleted, oil risks being violently repriced higher. So I had Gemini go through the mechanics of this article, and let's just check that real fast. I said, what are the mechanics behind this article and implied oil price model? It says the analytical reporting surrounding the UBS note details the mechanics of a highly specific macro energy crisis, the compounding effect of a sustained blockade of the Strait of Hormuz. Okay, it's the reason why I've got this handy dandy Hormuz deficit clock here so I can track this in real time. As a major maritime choke point remains largely closed, a massive supply and demand mismatch has emerged. The market's initial stability was artificial, sustained entirely by temporary buffers. The article details what happens when those buffers deplete, transitioning the global energy system from a standard linear deficit into a volatile, nonlinear physical shortage. This is what I'm talking about. The market is pricing in an energy deficit and supply crunch, a temporary disruption. It is not pricing in a actual shortage. This is the magical thinking that has saturated the marketplace now. So everybody not only believes that this is temporary and it's all going to go back to normal soon, but they really want to believe this as well. So not only do they believe this, but they also really want to believe, because nobody wants to think about the unthinkable. The physical mechanics of this scenario and the implied mathematical structure of the oil price model reveal how these dynamics operate. The core physical mechanics. To understand the model, we must look at the physical flow of oil. The market has survived a massive disruption because it has been drawing from three distinct shock absorbers. Here is the model that they have right here. So this is a nice 3D model which explains the relationship between supply shortfalls, demand destruction, and oil prices. Commercial inventories is the first shock absorber. That's right here. Commercial crude, commercial inventories. Okay? Industry held stockpiles used to smooth out day-to-day refining schedules. Strategic reserves, SPR, government controlled stockpiles like the U.S. Strategic Petroleum Reserve designed for national emergencies. Oil on water, the supply chain pipeline, the millions of barrels already loaded onto tankers and traveling across oceans before the blockade began. So in 83 some odd days, those tankers are not going through. It takes about 45 days for them to get to their various destinations on average. So there's now a 45-day window that has elapsed, as well as another almost 45 days of a complete blackout period. This transit delay created a multi-week lag before importing nations felt the true drop in arrivals. So the lag effect is initially a few to several weeks, then it progresses to a month to about 3 months, and then more ripple downstream effects really start to come into the market at around the 3 to 6 month mark. So we're at about 3 months into this. It's about to get real soon. According to data from the International Energy Agency, IEA, and UBS, global inventories fell from a near decade high of roughly 8 billion barrels in February down to about 7.8 billion barrels by April. They are on a trajectory to hit an all-time operational low of 7.6 million barrels. Concept of minimum tank tops. The fundamental flaw in assuming the world has 7.6 billion barrels left to use is failing to account for unusable inventory. In commodity economics, a significant portion of inventory is structurally trapped. This is known as tank bottom or minimum fill oil. A pipeline cannot transport oil unless it is completely full and pressurized. A refinery cannot operate if its storage tanks drop below a baseline level where pumps can no longer extract the fluid. This is what I've been talking about for the last few days. It's the tank bottom effect. Out of the billions of barrels in global storage, analysts note that only about 800 million barrels are truly discretionary or available to be drawn down. The remaining volume is purely operational plumbing. When that 800 million barrel discretionary buffer runs dry, the market hits a hard physical floor. The implied oil price model, standard commodity models assume a linear relationship, between supply deficits and price adjustments. If supply drops by 1%, prices might rise by a predictable percentage based on constant normal price elasticity of demand. Linear, right? It's a constant slope. It's linear. UBS warning relies on a nonlinear two-phase price model, often referred to in quantitative finance as a hockey stick or kinked curve. Price, tipping point, discretionary buffers equals 0. Phase 2, nonlinear panic above 150. Linear deficit buffer drawdown 90 to 105. So we've been in a linear environment with this, UBS has stated. We're about to go nonlinear, is their theory. Phase 1, the linear buffer drawdown 90 to 105. In this phase, the actual market deficit is hidden. The market is structurally undersupplied. Demand is greater than daily production, but consumers and refiners don't feel a physical shortage because they can simply order a draw from the SPR or a storage tank. Oh, this is what we're drawing. These are the figures, so they're down. They're going to continue to go down. Price elasticity appears relatively high because inventory substitutes for missing production. Prices rise modestly to price in a risk premium, which is why Brent sits in the 103-105 range despite over 1 billion barrels of cumulative production losses. Phase 2, the nonlinear tipping point above 150. Once discretionary inventories hit 0, the mathematical relationship between supply and price completely ruptures. The market is blown at that point. The model shifts from an inventory balancing mechanism to a forced demand destruction mechanism. When the physical oil is simply not available to purchase, the price elasticity of demand drops to near 0 in the short term. The curve goes parabolic for two reasons. Precautionary hoarding, the bullwhip effect, and consumers, refiners, and governments realize that physical stockouts running completely out of fuel are imminent. Rather than buying less because prices are high, they engage in a panic buying to secure whatever physical barrels remain, pulling future demand forward and aggressively driving the price up. A lot, real fast. Forced economic contraction because people cannot instantly swap oil for another energy source. The price must spike to an extreme absolute ceiling, modeled by UBS as well above 150 per barrel, where it violently forces businesses to shut down, flights to be canceled, and industrial supply chains to halt. Price is no longer rationing a financial asset. It is brutally rationing survival. The market and the world go from AI mania to complete and utter chaos. Survival mode. Nobody's going to care about their stock portfolio at that point. The secondary fragility, the microstructure, the underlying mechanics imply that the market has fundamentally lost its absorptive capacity. In a buffered system, an unexpectedly secondary event such as a North Sea pipeline leak, a bad Gulf hurricane season, or a refinery outage is a minor headline that causes a temporary $2 wiggle in price in a buffered system. That's the key concept here in a buffered system. In an unbuffered system where inventory is at the absolute floor, the distance between a routine supply event and a macro disaster collapses entirely. Any minor secondary disruption instantly forces localized physical stockouts, triggering regional panic pricing that flows immediately into refined products like jet fuel and diesel. Europe's going to run out of jet fuel in about 5 or 6 weeks. 4 or 5 weeks now, I think. That story is about a week old. The market is currently borrowing oil from its past self to survive the present. The core takeaway from the UBS and broader institutional modeling is that this structural borrowing has a hard expiration date. We're running out of time. While we read the same news headlines and the same, charade parade day in and day out, we're running out of time. We cannot do this for too much longer. We're already way past the point of extreme negative consequences in the future. Well, we're going to experience some very adverse situations going forward. The massive damage has already been done. Even if the war starts tomorrow, it's going to take months for the production to come back to where it was before the war started. If the geopolitical blockage outlives the remaining physical buffer, which it looks like it very well may, the market will reprice reality not through a steady climb, but through a chaotic vertical spike. We may wake up one day in the very near future and the crude is just trading at 200. It rallied $100 overnight and now it's like this. So it goes hockey stick and then it just goes like this. And then we just live in a world where $200 crude is just normalized. And the war is continuing and the Strait of Hormuz remains closed. The stock market will probably be at 1 million by then because they're going to have to print so much money to counteract the crisis that the hyperinflation is guaranteed. However, it doesn't really matter how much money they print. That's not going to solve the real problem that we're out of crude oil and gasoline. This is what it is. This is the reality of the situation. So I'm really not too sure how they're going to solve this one because for the last several weeks, their plan to solve it seemingly continues to go nowhere. I'm really hoping that they find a solution to this sometime soon. I am planning on running out of gasoline here myself. So even though I may be able to afford the prices of increased premiums for gasoline, I may not be able to get it. I'm definitely going to have to think very, very, very creatively about what the possibilities are because I'm definitely not buying the notion that things are going to go back to normal and that everything is going to be fine. Now, according to my calculations, this situation is completely out of control. That's all I got for you guys today. Have a good weekend. We get an extra day off from the market on Monday, so I'm looking forward to a holiday. So it'll be 4 days next week to trade. It's going to be real interesting because over the weekend we're going to get the truth about what's really happening with the war. Usually the escalation of the conflict always happens over the weekend conveniently when the markets close so that it provides as little negative impact as possible. So until next time, take care and I will see you guys on the next episode.